Hello everyone, this is Amanda McGuire and this is my week 7 discussion board for MBA 585. For this week's discussion, I'm going to be discussing tax avoidance, which is a legal way to reduce taxable income using loopholes in the tax code. This is a way to escape taxes or reduce tax obligations. The first method of tax avoidance would be the postponement of taxes. This is where capital gains are taxed. This is like the sale of an asset such as a home or a stock or a bond sort of thing. And when you sell those, it's considered income. And so that income is taxed. So in order to avoid this tax, there's the postponement of a sale. So someone may delay selling their asset in order to fall into a different tax year. If there's a different tax code that comes out that reduces the amount of taxes on it. There's also the option of, rather than selling your asset, to use it as collateral and when taking out a loan to purchase another asset. So that way you don't pay the taxes on the total income that would be received by the asset itself. The next method for tax avoidance is income shifting. This is the idea of shifting one's income from a higher tax bracket to a lower tax bracket to reduce the total amount of income tax that is paid. An example of this would be parents who put their income earning assets in their child's name. For example, if they have a business that makes a high income on top of their regular jobs, they could put the business under the child's name so that the child would be the one receiving that income technically and be responsible for the taxes, which would lower the parents' income tax bracket because they would be just with their regular income, not the asset on top of it. So there's that. And the third and final method for tax avoidance is called tax arbitrage. This is the strategy or practice where individuals or corporations manage to gain a profit from the different ways that their capital gains, assets, income, and different financial transactions are taxed. So it's finding loopholes within the tax code. An example may be that a company who has a business here in California and then a business maybe in, I don't know, Kansas or something, that the cost of their expenses in California are higher because the rent on the building that they're in is higher. The taxes are higher for sales, all of that, versus in Kansas where their expenses are lower, but their income may be higher. So what this business would do then is report both the expenses in the high tax location with the income in the lower location to ultimately maximize their deductions overall, which would in turn gain them less taxes that they pay, which would in turn gain a profit. So in looking at these three methods, the postponement of taxes, the shifting of income, and tax arbitrage, and seeing those used by people I know personally, I have seen a friend who her parents shifted their income by putting the business in her name, and so she was responsible for those taxes when she finished school and became responsible for the business. And that became her main source of income that her parents still benefited from. So her parents did that because it was a side business and they had their own jobs as well. Of the other two, I have a friend who postponed the selling of his home when there was a change in tax code and there was less income tax taken. This was recent, a few years ago. But tax arbitrage, I'm not really familiar with anybody in my life that has done so. And then reference-wise, all of this information I got from our textbook, approximately pages 746 to about 752. And that's all I have for this week. Thank you very much and have a good day.